Hello everybody, how are you doing? Now, making models is pretty tricky, but one of the hardest things about making a model is knowing where you've gone wrong. So, I'm about to teach you how you can read a model to see where you've gone wrong. And reading a model is much like reading a book. It tells you a story. You have all of these time periods, and in each time period, cash moves, and that cash movements really have a meaning. And so what we're going to do is look through a couple of examples of models telling completely different stories, and you can tell very quickly where the mistakes are. So why don't we flick over to this? Now, this model is a model made by someone who is kind of early in their modeling career, and they've made a few mistakes in it. And what I've done is they've been studying some of the Ascension materials, and they're quite early in that kind of experience. So there's quite a few things that they need to work on, but generally they're doing a good job. They're on a good path. And so they've made this model where they're trying to value this building, and they've come out with this cash flow. And let's show you exactly how you walk through a cash flow and understand what's happening. So in your cash flow, you have all of the periods that run along the top, right? You have your timeline up here, and your timeline is a certain period of time long. Now, every single column represents a period of time. Now, in this case, each column is a quarter of a year, okay? So in this column, this is the quarter of the year that runs from the 1st of April 2026 to the last day of June 2026, and it shows you what cash movements happen in that period. Now, that's what's happening along the top here. These are your timelines. Each column is the same period of time. It's the same length of time. It's each a quarter of a year, one after the other, okay? So it's like reading the future here, right? It's a projection of the future. And the second thing to remember about your cash flow is that on the left-hand side, your actual structure of your model is pretty much always the same. This is the same with all cash flows. You have cash flows from operations, that's the bit at the top. You have cash flows from investment. Now, in the world of real estate, cash flows from investment refer to any time where you're buying, selling, or renovating a property, or maybe even developing. So that's the investment-y type cash flows. Buying, selling, renovating, developing, okay? Just to remind you, the cash flow from operations in the world of real estate is usually rent. That's right, getting rental income. Now, you might do some operations around it. You might give rent frees, you might do TIs or works to properties. That all sits in this top section, which is revenues from operations. Okay, so revenues from operations, we've got revenues or cash flows relating to our investment activities, buying, selling, renovating, redeveloping. And then you've got cash flows relating to financing. That's it, there's your three. Operations, investment, and financing, okay? So you know how to read these bits down the side. Each of these headings falls into one of those three categories, and you know what time period they relate to. So, without further ado, let's read this cash flow. Okay, now in period zero in an acquisition investment model, when you're doing all your financially modeling bits, it's always the acquisition period, period zero. And so this says, look, in period zero, we buy this building for 3 million. We have a bunch of different costs associated with that acquisition. And then we end up paying in total 3.35 million to buy it. Makes sense. We don't collect any rent because this is assumed to happen at the end of this quarter. You buy it right at the end of the quarter, so of course you don't collect any rent for that quarter. And then you've got a bunch of legal fees related to borrowing money. Because when you buy the building, you're going to borrow money to buy it. So now we're in our financing section. Look at this. We pay some costs, because minuses mean that you're paying out of your investor bank account. So you're paying all these arrangement fees, lenders' legal fees, borrowers' legal costs. But then down here, you get this big fat plus. Now, a big fat plus means you get money coming into your bank account, okay? So this big fat plus tells us, oh, cool, we just made 2.2 million from our financing. So we've drawn, in this case, a loan from a lender. It's giving us 2.2 million. So in total, we look at the very bottom of our cash flow here, our levered cash flow, which is basically the same as the bank account or the cash flows for the investors. And you can see, look, we have to pay out in total 1.3 million. That's because we've got this investing cash flows where we've got to pay out 3 and a bit, and we make a bunch of money, 2 and a bit, from borrowing. So the net of that is that we as investors have to pay out 1 and a bit to buy our building. All right, well, let's see what happens in the next quarter, shall we? Well, next quarter we own the building. Very nice, we collect some rent. Let's keep going down. Is anything else happening? So we've got this, these are the cash flows relating to operations, funds from operations. Keep going down, nothing on the investment side. No, we're not renovating the building, we're not selling it. All the way down, we don't have any more of these like legal fees and bits. Cool. And we're paying interest. Cool. We pay some interest on our loan, makes sense. And we repay some of our loan. That's called amortization. Oh, okay. So we get in 53 grand from rent, but we're paying out 30 to pay off the interest and the amortization of our loan, so we get to keep 23 grand. Straightforward. Let's have a look at what happens in the next quarter. So this will be the second full quarter where we've owned the building. Let's have a look down. We collect rent, we pay interest and amortization. Job done. Okay, next period. And so on, and so on, and so on. And so you just keep reading it, and then keep going, because many of these cash flows are kind of the same. Look at this, nothing really happens. Roughly around here, we get some rental increase. So we should understand why we get a rental increase between quarter 16 and quarter 17, just at the start of year 5. But generally, that seems fine. Now, this starts to go a little wrong here. Look at this. Still keeps going, still keeps going. We're holding this for a long time, presumably. And all of a sudden, look, this is weird. What happens in this period? We collect our rent as usual, very nice. Got no finance. We've got no investment activity, so we have no cash flows from investments. We go down to the cash flows from financing, and what is this? We not only pay our interest, but we pay 1.775 million to the bank. What? Why does that happen? Well, it says that we're repaying all of the rest of the loan. Because you can see here, there's no more interest to pay, there's no more amortization to pay. We basically repay the loan at the end of year 6. So we as investors, look, our cash flow has been positive. We've got money coming into the bank every quarter. Then all of a sudden, at the end of year 6, we as investors have to pay out 1.7 million. That doesn't make any sense. So all of a sudden, when I'm reading this cash flow, what? Why all of a sudden have we said we're just going to repay this loan? I'm not sure that would happen in reality. I think what would happen in reality is you go get another loan at the same time that you draw so that you could repay the old loan and draw the new loan so you wouldn't lose money as investors. You wouldn't have to pay this money from your bank account as investors. So I already know there's a problem with this model now, just by reading quarter on quarter. Let's keep going. Keep going, keep going. We're collecting rent, collecting rent. All of a sudden, at the end of year 9, we just stop collecting rent. What? Why would we just stop? I can see, I'm looking at the cash flows from investing. It's not showing that we're selling the building. It just shows that we stopped collecting rent. And then it's empty. Look, we've got these void costs that all of a sudden appear in year 10. And then we do a bit of TIs and CapEx. So this is all a very weird model. We buy a building that we never sell. Halfway through owning this building, we just repay the debt, don't do anything else. And then we leave it empty. That is reading a cash flow, okay? So you can see very clearly that it stands out that there's a problem here. Now, let's take a look at this one. This is another model. Again, this is a bit more of an advanced model that's been made as part of the Capital Markets Accelerator course, one of the exercises that someone's doing. And it's a it's a portfolio of industrial units and retail units, and it's got a very messy lease structure. And so if you're learning on the Capital Markets Accelerator course, you'll learn how to handle that kind of level of complexity very quickly. So I'm just going to look through, yes, we've got debt. Okay, let's look at the cash flow. Again, same cash flow structure. Each period in this case is how long? Each period is a quarter. So one quarter after another. So we can read it like a book. We can read quarter after quarter what we think is going to happen. And we've got debt down here, same as before, same as the other model. So let's have a look. So in period 0, that's pretty much always your acquisition period, don't forget. We've got, we're buying this building for 13.25 million, and we've got a bunch of costs, so we end up spending about 14 million. Makes sense. And as I go down, so that's the cash flows relating to investment. As I go down in this same period, we've got some costs associated with borrowing the money, and then we borrow £9 million. We get a plus of 9 million. And at the bottom, we as investors need to be putting out 5.2 million to end up buying this building. Okay, that all makes sense. Let's go to the first full quarter since we own the building. We get some rent. We've got two different types of rent here. Look, rent from existing, presumably leases, and then we've got rent from new leases. Okay, so we've got some new leases starting, and these existing leases presumably are declining over time. Let's have a look. If I just look along that line, I can see this number declining over time, and I can see the rent from the new leases increasing over time. So presumably old tenants are leaving, new tenants are coming. It's an interesting thing to look at. So anyway, so we've got a whole bunch of activity here. We've got some rents that we've got coming in. We've got some void costs, so we've presumably got some empty space. And then we've got some tenant improvements. So we've got new tenants coming in and we're paying for those works. We don't have any investing activities going on. We don't really have much in the way of legal costs, except we have to pay an agency fee. Makes sense. And we've got to pay some interest. So in our first quarter, this is interesting. We only bring in about 50, 60K, and we're going to have to pay out about 120 or 130 in debt costs. So we end up paying out 70 grand. Interesting. That's an interesting read of a model. Let's have a look at the next quarter. What happens here? Okay, we've got 186 grand in plus that. Okay, we've still got some void costs. So we're actually getting 150 grand in of income this time, and we're paying out about 130 of costs around the debt side. Here we go. So we end up with 20 grand positive. Next period, there's a lot going on here. Look, our rent's fallen, and we've got some new rent coming in that's increased. And then down here, we've got some rent frees that we're giving away. So we've got new tenants that have started. We've got some void costs, which are now finishing. Look, we've got no void costs after that. So we're fully occupied from this point on. And we give away large amounts of tenant incentives. There's lots of works happening right there. Cool. So you can see just by reading this, in this model, you've got a lot of leasing activity happening around here. And, you know, you're giving away rent frees, which last quite a long time. But generally that leasing activity kind of becomes a bit more normalized. It dies down quite a lot. You've got a bit more leasing activity going on here, further down the line. But generally, you've got rid of your vacancy here, so you've leased up your building. Okay, makes sense. We don't really do anything to the building. We're not renovating it throughout the holding period. And we're going to sell it at the end of year 5. So it's a business plan year 5. And look, if I look down here, here's where we sell our building. And after we've sold our building, guess what? There are no cash flows because we sold it. Right, so let's skip all the way to the last cash flow because this is really interesting. So what this tells me is we've got some lease up activity. It's a pretty normal building. We hold it for 5 years, and in the last period of 5 years, we collect our rent. Makes sense. We sell it for 16 million. We've got some costs on that. Fine. We pay our little agency fee on the debt side, and boom, we repay the outstanding balance of the loan, which leaves us as investors £6.8 million or 6.8 million in our pocket. Okay, so that's typically how I, as an experienced modeler and investor, would look at a cash flow model. And I literally walk through quarter by quarter, month by month, year by year, depending on what your periods are, what you say is going to happen. So when you build your models, you should do the same thing. Read it like a book. What is the story that model is telling you? Because this model here is telling us a pretty wacky story. It's telling us one where we repay debt without drawing any more. We don't sell a building, we just stop collecting rent. There's definitely something wrong with this model and I don't trust it. So these numbers don't make sense to me. Whereas this model is telling us a really coherent, sensible story. I believe it, it makes sense to me. Okay, cool, I trust it. All right, well look, I hope that helps. We do a lot of this work in the Ascension training kind of professional courses if you're interested. So if you want to be an investor or a developer or anything in industry, an asset manager, we actually have a large number of people coming through from industry and getting trained up in how to build models, how to understand models, how to read models, and how to tell stories with your numbers. So get in touch with us if you're interested. And otherwise, we shall see you soon for some more interesting content. Thanks, everybody.